Welcome, everybody. This is Institutional Trading Strategies. I'm your host, Andrei Knight. Hopefully you're in the right webinar. And if you're not, don't leave. I promise to make the next 45 minutes really interesting and worthwhile for you. How's your week going so far, you guys? You finding some pips out there? Anyone? Okay, well, let me share some ideas that'll hopefully help. There we go. One. Thank you, John. Oh, Ron, you as well. Okay, good. Indeed, FX trader. Question is on some pairs for how much longer? And what's coming next? That's always what we're trying to answer. I'm going to show you on one example. Very nice trade we've been in. And also, not only what's likely coming next, but why we think so. Yeah, the euro I'll look at if I've got time at the end, John. That's one we called in here, in this very room, a couple of classes ago. Just hit our target. Some of you guys might remember that one. Not all, Anant. Hit ours smack where we were expecting it would, actually. But I'll show you how I arrived at that one. Time permitting, I'll show you what's got my attention on the dollar Swiss right now. It actually doesn't surprise me at all that we did not make a higher high today, despite the bullish open, despite the bullish indicators. Doesn't surprise me at all that today's body looks like it's going to be smaller than yesterday's body. I'll show you why. But before I get into all that, before I even get into the chart with you guys, I'd like to cover the key elements of what sets institutional trading apart. What do you guys think are some of the biggest differences between how institutional traders trade and how most people trade? You all know the statistic, right? 95% of traders lose. The whole quote, actually, that's just part of it, you see. The whole quote is 95% of traders will lose their entire account within their first 6 months. Ooh. With statistics like that, why even bother? Because I'm here to show you today that it's easier than you think to be among the 5% who win and win consistently. And it doesn't even have to do so much with your choice of indicators. As we get into this, I'll show you most indicators are interchangeable. You know, people will often ask me, what's your favorite indicator? It's one of the hottest topics of discussion in forums. Well, which indicators do you use? It doesn't matter, you guys. That's not what separates institutional trading from the way most people trade. I consult trading institutions. I've seen a lot of trading desks. I've seen as many trading systems as I've seen traders. That's not the common thread. My indicators don't work any better if you color them purple and blue instead of green or red. What color you make them is just as relevant as what socks you're wearing while you're trading. Is just as relevant as what kind of indicators you're using, you guys. Yeah, there you go, John. You put your indicators away. It has more to do with mindset. And you guys touched on some of it. Money management is certainly a factor. If you blow a bunch of money on one idea that didn't quite work out, or maybe the idea was good, the timing was wrong, and the rest of the time you're playing in catch-up mode, that's going to make it very hard to stay ahead. Sizing positions, absolutely. Big part of it. Money management. Risk-reward ratio, one that's overlooked. Okay, I could have the perfect setup according to my system, but if the distance to my target isn't at least 3 times longer than the distance to my stop, all other things being equal, I'll pass on the trade. I have to stand to gain more than I stand to lose in order for me to even consider the trade. Why? There's an insurance policy in that. Assuming I'm following the system, assuming everything else is correct. If I maintain a 3-to-1 risk-reward ratio, think about it for a minute. As long as I get 1 out of every 4 trades right, I'm still breaking even. I might have 1 or 2 little losses, but the moment I have a win, it wipes out all the losses and then some and puts me ahead. I only have to be right 25% of the time. That makes it much easier. My system, of course, bats a little bit better than 25% win rate. It's closer to 77%. Big wins, smaller losses. It's a key factor. Combined with money management, and Boyke, you hit the other one. Have a plan. Because here's how most beginner traders trade. Ooh, we made a higher high, let me buy. You know, or like in this case, we had an up move. Oh, we're moving down now. Let me close my long, let me short. You're always chasing the market. You're always behind. The slightly more sophisticated trader has a trading strategy, a system, hopefully one they're following, because having it is not enough. You actually have to follow it in order for it to work. A lot of people think they're following their system, but they're still making emotional decisions at the end of their analysis. That's not following a system. So assuming you're slightly more sophisticated and have a system and are actually following it, you're still chasing. The system generates a buy signal, you buy. The system generates a sell signal, you sell. If it were that easy, trading robots would be making money. You guys ever tried a trading robot? What happens on if you leave it long enough? It slowly loses money out of time, over time. Pardon me. So clearly there's more to it than even that, following your system. The key to being ahead of the markets instead of behind the markets, you hit it, Boyke, is to have a plan. My system just generated a buy signal. Is it a buy signal worth taking? Oh, yeah, oh. That's something a robot cannot do. It's called judgment. Does the entry make sense, given what I expect to happen next? I don't generate all the entry signals my system, or I don't take most of the entry signals my system generates. I pass on them. And not just because of the risk-reward filter. I'm not waiting for an entry. I'm waiting for the entry, a specific one. Therein lies the key, you guys. And either it comes and I act on it when the trigger comes, or I don't. Okay, it's not that I'm waiting for my system to generate an entry. It's that I'm evaluating all the possible entries given the scenario that I'm in. And either it fits with it or it doesn't. But you see the difference. It moved up, I'm going to buy as chasing. What a lot of people don't realize is my trading system generated a long entry, I'm buying, is also chasing. I'm waiting to see if my entry system generates a buy signal or not. At this point in time, at this price point, is a very, very different way to trade. Now the markets are coming to you. It's not you chasing after price. And it can also affect what you're talking about, Nathan. Knowing whether to get out on a retracement or not. Some are just that, short-term retracements. Others can be the beginning of a longer-term reversal. How do you know the difference? You have an awareness of the bigger picture. A bounce in some places isn't significant. A bounce in other places might be very significant. It all depends on the context. A small number of high-odds trades, exactly. You don't get paid by the hour. You don't get paid by the trade. You get paid when you're right. So once my trading system generates an entry, I apply all these other filters, including scenario, including risk-reward, and obviously money management, sizing of my positions, to see if I'm going to take that entry. And in the end, I end up trading way less. I'll grant you. The trading day gets a little more boring. It's not quite as exciting. I'm not here for excitement. You want excitement? Go to Vegas. The drinks are cheap or free in most cases while you're experiencing your excitement. That's not what we do when we sit down at our trading desks. I trade way less, but a higher percentage of my trades are winners, and what I said before, when they're winners, they tend to be bigger winners. Okay, it's a double-edged sword. More of them and bigger ones compared to the losses. Okay, so I'll show you guys how to find the bigger moves and how to stay in them longer and how to be right more often. Those are the keys that set institutional traders apart from the struggling ones. What choice of indicators and colors I use to accomplish that? You know, I have a preference. I have mine that work for me. I'll share some of them with you today. You might have your own favorites. You don't have to necessarily change how you're finding the entries. You have to change how you're evaluating them. Okay? So that's the principle. Let's put it into practice. A little bit about what you're seeing on your chart. Okay, in the center of my screen, this is how I generally orientate myself within a trade. Or within a move, I should say. The line in the middle here, the purple one, this is the 21 EMA. 21 period exponential moving average applied to the close. Why 21? Well, I've heard there's 21 trading days in an average month. Forex is a 24-hour market. But if you add up the Asian, European, and American sessions, it's usually the most active 21 hours of those 24. 21 is also a Fibonacci number. You know, all those explanations sound great. Honestly, you guys, it's because I've tried the 20 and I've tried the 22. 21 works better. I've tried the simple and I've tried the exponential. The exponential seems to work better more of the time. That's the only real reason I need. It works. Just throwing that one line on your chart already gives you several clues, you guys. Is the moving average aiming up or down? Are you over it or under it? Are you moving away from it? Are you falling back down towards it? Look how many filters we can apply already and what we can learn, and we've just put one line on our charts. Okay, the purpose of an indicator is not like some magic voodoo formula. It's to help you orientate yourself within a move. Okay, a move up and away from a 21 that is aiming up while you're above it means something entirely different than a move up when you're under the 21 and it's going down or sideways. Remember I said context is key? That's one way to establish context. Javier wants to go straight to entries. He doesn't value what I just said. Finding yourself within the scenario. I will entertain your question, Javier, nonetheless. Javier wanted to know how we use the 21 and the tunnel of fives to find an entry. Are you going to know whether to take that entry once you found it, though? That's the real key to successful trading. Not finding it, but deciding whether to take it once you found it. But I'll humor you, my friend. The tunnel of fives is this slightly brighter purple pair of lines right here. The dotted ones. Okay? They are a pair, meaning two, of smoothed moving averages, which is a type of exponential moving average. It also puts weight on the most recent price action. It just calculates it slightly differently. Okay, so a pair of 5-period smoothed moving averages, but this time instead of the close, one is applied to the high, one is applied to the low. And that's what creates this tunnel effect, hence the name tunnel of fives. And you can see sometimes it's right on our 21, Javier. Sometimes it's further away. Some of the time it's above it because we're currently in an uptrend. You know, if I go to a different part of the chart, sometimes it's below it. It's kind of a buffer zone. I call it the noise filter. An up move inside the tunnel of fives doesn't mean very much. An up move outside the tunnel of fives is usually the beginning of a new trend. Okay, so one way to find entries is to be on the correct side of the 21, have the 21 aiming in the direction of your trade, making sure that once you break the 21, you retest it from the other side. In this case, what could have potentially been resistance back here has to test as support. Okay, so on the correct side of the 21 with a retest, you take the first open on or outside the tunnel of fives. In other words, this was a bullish open, but the retest hadn't happened yet, and it's still inside the tunnel of fives. It could be noise, which is why it didn't go very far. But once you open outside the tunnel of fives, take a look. Usually you keep going. If you have retracements, they usually stay outside of the tunnel. Okay, so you could effectively say that's kind of where the trend really kicked off, and you had extra assurance it wouldn't drop back down. So that's one of the ways I pinpoint entries. Correct side of the 21, 21 aiming in the direction of my trade. the first open outside of the tunnel. Okay, I usually like to confirm it with at least one indicator. Let's take a moment to look below the charts. Oh, the other moving averages I like to use, by the way, the 50 and the 200, in this case, simple moving average. Okay, why simple in this case? Because if I'm averaging 200 periods, I don't really care about the most recent price action. Otherwise, I wouldn't be averaging 200 of them. Okay, the longer moving averages, my rule of thumb is 50 and up, 50 periods and up. The longer moving averages I'll make simple. The shorter, quicker moving averages I'll make exponential. And the smoothed is just a different type of exponential. If your trading platform doesn't have smoothed, by the way, you can substitute with an EMA. In that case, I recommend there's usually a shift box as well. Put a 1 in there to make it behave a little bit more like smoothed. Okay, so either smoothed or exponential with a shift of 1. The other thing you're seeing on my price chart, this is called an envelope. Some trading platforms call them channels. Essentially also a 21 exponential applied to the close. You'll see it, all three lines are parallel. What makes the envelope different is you put in something called a deviation or a distance setting. And that's simply how far away from the 21 you are. And all I do very simply, I further back on my chart. Here we go. Okay, further back on my chart, I found the other big major reversal we had. And distance is kind of trial and error. But I kind of try to bisect the middle of the reversal, if you will. Here we're a little below. Here we're a little above. Kind of try to cut it in the middle. Okay, aim for like right between the bodies and the wicks, usually if you can get it. That's the best spot. And the idea is, if you identify a reversal at some point back in history, let me go back to the right edge of the chart, you're going to have a pretty good marker or predictor of where the next reversal is going to be. Kind of like the Bollinger Bands, except it doesn't get wider as you keep going up. It stays parallel. Okay, so the settings are 21, exponential, applied to the close. Distance is going to be different for every pair, every time frame. You do it visually. Find a reversal and bisect it. Okay, so now we're either at a 21, moving away from it, or we're at an envelope moving back towards it. See how I can instantly orientate myself. Going back to this, for example, as an example of entry, looking below this, you'll see a couple indicators. I'm not using all of them all of the time. Okay? The first one you encounter is called OSMA. This is a momentum-based indicator. Another example of a momentum-based indicator is the MACD. Notice I even use the same settings as a MACD, 12, 26, 9. That's how interchangeable they are. I can even use the same settings. The point is I'm measuring momentum. Is it increasing or decreasing? Acceleration, deceleration, another way to put it. If I go one down, this is ADX. Itself a momentum-based indicator. I use a little differently. I've got the positive DI and negative DI lines grayed out. I'm just focusing on the average line. I'm using the standard setting of 14. And I've got a cutoff at 30. Okay? The way I'm using it, I'm simply measuring strength. Strength greater than 30, I assume when I hit support or resistance levels, I've got enough strength to break them. And when you break support resistance levels, you make higher highs or lower lows. Gee, that sounds like the definition of a trend. Bing, 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 bing. When I've got an ADX over 30, and I'm in a trend and support resistance levels are breaking, I don't know where the finish line's going to be, I'm more concerned with momentum. Are we building it or losing it? Right? If you're in a trend, are we accelerating or decelerating? You know, in this case, when we started decelerating, you could have taken profit. You could have gotten back in when we started accelerating, and you wouldn't have missed anything, except a few days of sideways chop. You would have gotten out right when the trend petered out and gotten back in at almost the same price level before it resumed again. Okay, so in a trend, we don't know where the finish line is likely to be, so we pay attention to whether it's accelerating or decelerating, i.e. momentum. If your strength falls below 30, support resistance levels are likely to bounce. And when you're bouncing back and forth between two levels, that's called a range. When you're in a range, I like to use an oscillator because it oscillates up and down, telling me whether I'm in a bullish or bearish wave of that range. Any momentum-based indicator will work in this position. Any oscillating indicator will work in this position. Feel free to substitute the stochastics with an RSI. Just change the 20 and 80 to 30 and 70. Feel free to substitute in the CCI. Just change this to negative 300 and positive 300. They all work the same way. The point is, make sure you have one from each group. Every indicator out there will fall into one of these two groups. But which one you use really doesn't matter. Pick your favorite. The idea is when in a trend, pay attention to momentum. When in a range, pay attention to the oscillations. Notice there was a period when this went flat. Wasn't very useful at all. Note that during that time, we were over 30 the entire time. And notice these two beautiful peaks on my OSMA. When one indicator starts failing you, the other one will usually take over. If I find a spot on my chart where we were under 30 for a long time, notice how these peaks, you know, while still visible, sometimes you go into total zebra mode and they're all the same height. In this case, they're still visible, but look at how much smaller they are than either to the left or the right. Meanwhile, I've got these beautiful, nice oscillations on the stochastics. So when one indicator is giving you good signals, the other one will usually be inconclusive. That's the key to indicators, you guys, knowing when to use which. Not to find one ultimate super indicator that works all the time. There's no such thing because market conditions are always changing. The differences between MACD and OSMA is how they do the math. DZ, the similarity is that they're both measuring momentum, just in a slightly different way. It's looking different because there's differences and particulars in how to use each one, but in a nutshell, they're all telling you more or less the same thing once you learn to read them correctly. Anand? You know, like ADX I mentioned is also a momentum indicator. If I were to make the positive DI line green, in keeping with my color scheme, the negative DI red, check this out. When I'm printing red bars, the red line is on top. When I'm printing green bars, the green line is on top. When the lines get further apart, the bars get longer. When the lines get closer together, the bars get shorter. So in the end, they're telling me the exact same thing, just in a slightly different way. That's why I gray this out, because it's redundant information. And in my case, I use ADX purely as a strength indicator, or in other words, purely as an indicator selector. So going back to this moment, we broke above the 21, we retested it as support, we opened outside of the tunnel of fives above the 21, and it itself is aiming up. That sounds to me like an entry. Do I have indicator approval? I glance down, ADX is above 30, so I want to go up to the momentum indicator, and yes, this bar is higher than the prior one. Boom. I have indicator confirmation that that move is worth taking. What happens when you have a good entry but the indicator disagrees? Those are the ones that usually still go up for a little bit, but usually they leave a wick and drop back down. In other words, they go in the direction predicted, they just don't go very far. And remember, I said we're looking for bigger winners. Right? I want something that's going to go far in that direction. It's not enough to just be right. Hey, it went the way I thought it would. It's got to keep going in that direction. Scenarios and indicator support are the two ways I do that. But notice, I didn't look at my chart and go, oh, it turned from red to green, I'm going to buy. That's leading with your indicator. No, I figured out I was going to buy based on what price action is doing. And I simply glanced down to decide, is it likely to go far in that direction or not? I use the indicator to confirm what I've already decided based on price. I don't decide with the indicator, which is what most people do. JP asked how long one waits for a retest. It's not a matter of time, JP. You know, in this case, it happened on the very next candle. We came down, bounced back up. Sometimes, you know, it can take several candles. It's not so much time-based, it's that I need to see it. It's not enough to break a level. Here we broke below the 21. But a downtrend didn't ensue. Why? Because it failed the retest from the other side. So it's more a matter of a formation rather than how long it takes. Okay? And then the open outside the tunnel of fives comes after. It's not so much that you're retesting the tunnel of fives. That's why it's a dotted line. You retest the 21 once you cross it to make sure you're going to stay on that side. And then you wait till you move outside the tunnel of fives. At that point, the move has gone on long enough to be the start of a new trend, and it's not just a lurch. You know, all of these are all false starts, and they ended up being very small-bodied candles because they all originated inside the tunnel. So first the break, then the retest, however many candles it takes to form, and then the first open outside the tunnel after that retest occurred. Assuming you have indicator support of the indicator ADX is favoring. And your other question, how do you get the different color shades? We programmed this ourselves. But as someone mentioned, if you look on Google, you might find a version of Ozma. I'll tell you guys about our training program and workshops at the end of class. If you sign up for our training, we include a copy of all these indicators and a template to actually load and configure them all for you. So literally, you just load in the template and go. You don't have to go hunting for the individual indicators. But I'll tell you guys all about that and how to get that at the end. What do I think about chart patterns? It depends on the pattern, Boyke. I found some to be more reliable than others. Usually the chart patterns, particularly when I see them on the longer term, higher time frames, are what key me into a scenario to begin with. You know, if I'm moving down after a double top, I'm likely to continue moving down. If I just had a break retest, I'm likely to keep moving up. When they happen, and the context of where they happen, is usually what then sends me down on the lower time frames looking for an entry. You know, if I've just formed a double top and I'm moving down on my higher time frame, on my lower time frame, I'm probably going to ignore any long entries it generates, right? It doesn't fit the context. But if it generates a short entry, okay, that's worth taking as long as there's still distance to my 21 on the higher time frame, right? Because that's usually how far we drop after a double top. So it's part of how I orientate myself. Do I jump on it or not? It depends on risk reward, and it depends on whether the indicator ADX is favoring it, supports it or not. You know, it goes through some additional filters after that. So let's apply everything we've discussed to figure out what the dollar Swiss is going to do next, because it's led to a couple very profitable days so far. The question now is, it didn't make a higher high. Is it likely to go further? And if so, how much further? And how do we tell? Or maybe this is the beginning of a reversal, even though it's still a green candle. Gee, isn't it nice to know all that stuff? All right, well, let's get the bigger picture. I'm going to zoom out to the weekly chart for this because I want to see where that uptrend initially began. I'm going to put up a fib. Those of you that were here Friday know that's one of my favorite tools. If you weren't here, if you don't know how to use fibs yet, on Friday the 10th of October, which is a week from this Friday, I'm going to repeat my Fibonacci webinar, and you can learn all about fibs. Thank you, Ron. Okay, so you were there. You know how to use fibs. We're going to take it now to the next step. Combine them with indicators to confirm their signals. If you don't know how to use fibs, don't worry. Okay, I'm not going to spend a lot of time on it today. But Friday, October the 10th, I'm going to do a whole session all about fibs, and you'll learn how to use them. In a nutshell on this one, this was a retracement to 50%. We hit our 161 target. We went on to have two bonus rounds from 161 to 200, and then from 200 up to 261. So now let's go back to our daily chart. Look at where we are right now. And you should be kind of going, oh, okay. Okay, now we have some context to work with. By the way, this was the trade of the past 2 weeks, right? We broke above the 200. We retested it as support. We formed a doji or near doji. Hanging man is the name of this particular formation. And we opened above the top of the hanging man. And at the time, okay, this is a little bit of an optical illusion. At the time, outside the tunnel of fives. Wait a minute, it's inside the tunnel. You're smoking something. Look very closely. Can you guys accept that the cross of this hanging man is outside the tunnel of fives? Yes? Everybody agree with that at least? The cross of the hanging man is outside the tunnel at the time back here. This opened in the same place that this closed. Can we agree on that? It also opened at the same time that this closed. right? So therefore, at the time, this would have also been outside the tunnel of fives. It's because we've had several green candles in a row. Remember, this is made of moving averages. So it moved. This won't happen when you analyze a live chart. This is just a little trick of historical charts because this moves as these form after it. But at the time, this closed outside the tunnel of fives. This opened at the same time and roughly the same place. Okay? So on historical charts, always look at the close of the candle before rather than the open of the current candle to see where you would have been at the time. Okay? So we broke above the 200, retested it as support, opened outside the tunnel of fives and bullish to the hanging man or near doji, the candle before. ADX was over 30. Osma was going up. Boom. That was the entry back then. And our target, which we closed yesterday, was the 261 fib at 95.75. Of course, intraday looks different. First, you got to identify the trading scenario. Okay? We're moving from here to here. We want to do it right of this line. That's the overall scenario, Nathan. The individual trades within that, well, I got to wait till the 4-hour chart is bullish. Okay? For example, here the 4-hour chart went bearish. More than likely, we would have been out of this segment. Then it went back to bullish, we would have been back in. It went to bearish, we would have been back out. It went to bullish, we would have been back in. So this is one scenario, but it resulted in 3 separate trades. Okay? We're not going to take long entries while our directional time frame is bearish. We're only going to take them when they're bullish. Okay, well, it was bullish pretty much from the start. Turned bearish here. Turned back to bullish about there. Turned bearish there. Oops. That landed in the wrong spot. ADX over 30, we got to wait for the Osma. Let me just do it that way. That was your first bullish bar. And then it started turning bearish after we hit our long-term target. About there. Okay, so the scenario is we go from here to here. That automatically rules out all the points where we're bearish because we're looking for a bullish entry. It was bullish in 3 points, okay? From here to here, from here to here, and from here to here. Then on our 1-hour chart, we basically only take long entries that are between those bars. Okay? Here we're outside the tunnel of fives above the 21. But the 4-hour chart wasn't yet bullish. That happened here. And notice none of these bullish entries went very far. Ding, 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 ding. But the first time we opened outside the tunnel of fives, after this bar, that's the one that started going and kept going. Okay? Oh, reversal. Should we get out? 4-hour chart was still bullish. We reversed outside the tunnel of fives. We made another attempt at recovery. This one didn't succeed, but we made another attempt. This down move, we never recovered from. You know why? Because the higher time frame turned bearish with it. So there's trade number 1. You know, trade number 2, same thing. be above the 21, wait for it to retest as support, take the first open outside the tunnel of 5s, assuming the indicator ADX is favoring, in this case under 30, so stochastics is bullish, and it is, green over red. So there's the next entry. Again, not on the line, but sometime after the line. Okay? One trade scenario, the blue square, resulted in 3 separate trades. You could stay in, Boyke. You didn't gain very much. You know, these would have been hours you're just biting your fingernails. Or worse, getting out, getting scared out, and getting lured into a short trade that didn't go very far because it didn't fit the overall scenario. You know, it's a question of time frame. You could trade with the daily as your lower time frame, the weekly as your higher time frame, and you do stay in it. On the hourly chart, that's too many hours of a counter move to make it worthwhile to stay in. You know, that's what I'm really identifying. And beyond that, this total move is a move of approximately 202 pips. But notice what we did. You know, trade number 1 was 142 pips. Trade number 2, 54. Trade number 3, and notice I'm not measuring these even from the very bottom. I'm measuring them from where realistically you would get in, right? I'm not measuring from down here. Also 50 pips. Add that up, you guys. What do you get? I'm going to put a calculator up so you can see it. 142 plus 54 plus 50, 246 pips. Okay, you get me, Boyke? That's why I like to subdivide into bite-sized chunks. Not only do you have to sit there and chew your fingernails through retracements, but you actually get more pips out than the sum total of the move. I just gave myself a 44 pip spread. Or pardon me, 44 pip advantage. Less spreads, yeah, but come on. What are spreads? Pip, 2 pips? It's worth it. Okay, so that's, in a nutshell, how we got to this point. Let's focus on what's coming next and how to tell. Lest somebody accuse this of only working in hindsight. Well, very simply, today's close will either be above or below 95.75. If it's above, I'll wait for us to retest from the other side as support, and I'll trade to the next fib level. If it's below, I'll make sure we also open below, making sure it's holding as resistance. And I'm going to trade, probably splitting it up into two trades on the way down, back to my daily 21, which by the time I reach it, keep in mind, will be higher. And then if I break the 21 and retest it as resistance from the other side, down to the 200. Okay, so if I open below 95.75 tomorrow, I'm going to ignore any long entries my system gives me. It doesn't fit this scenario. Meanwhile, any short ones, assuming the 4-hour is also aiming down at that time, I will gladly take. And I know where to, so I can calculate my risk reward. Right? If you have no idea where price is going to, how do you even begin to calculate risk reward? No wonder that we've been struggling all day above and below this level. It's an important one to determining what's next. Stochastics look like they're flipping to bearish. ADX tells me it's not the stochastics we need to be concerned about. The OSMA's still bright green, but I bet you if we spend tomorrow below 95.75, you'll get a dark bar here. If we spend tomorrow above 95.75, I bet you'll get another bright bar. Okay, so not only did we know where we're trading to the first part of this week, we have a very easy way to tell what's next. Real quick, and then I got to wrap up. Euro-USD. We covered this last week. Let me find the fib we were watching last week. Maybe it was off the daily chart. Was it this guy? Yeah, there we go. Okay, this was the same type of thing. Except upside down, yeah. That's the one. We were trading down to 26.76. Then when we activated the bonus round, breaking below the 161, we had the secondary target at the 200. Okay, not surprisingly, that's where we bounced yesterday. Are we now going to start our journey back up? Is it time to target 26.76 again? Not today, because today the indicator was still bearish. That's why today was more or less a back and forth day. When this starts to turn and takes the indicator with it, then I know first we're going to go to our prior D target. And then from there, very likely to 0 or the 21, whichever comes first. Conveniently, right now, they're in the same spot. Envelopes, Manuel, 21, exponential, applied to the close, distance set by eye. Try bigger and lower until you identify a prior reversal point. If you cut it right across a prior reversal, you will have a pretty accurate predictor of where the next reversals will likely take place. That's, for example, one thing that made the bonus round more likely than the D. D didn't bring you to the envelope. Here we have a Fibonacci level and an envelope intersecting. Good place for a reversal, which is why we bounced up. Whether it takes the indicator with it or not tomorrow will determine whether it's going to be a prolonged reversal or not. And then I will take entries only in the correct direction that match the scenario I'm in on the lower time frames now, when the higher time frame and the indicators support that entry. And I have at least a 3-to-1 risk reward or better. That, in a nutshell, is institutional trading. Not looking for entries, but figuring out which entries make sense given the context, given the risk reward. Which of the entries are worth taking? Okay, you will trade much less, as I said, this way. But more of your trades will be winners, and the winners will be bigger than the losers. That's key. All righty. Let me give you a couple links to go further, if you so wish. First one is a free gift, you guys, no cost at all. I publish a electronic newspaper every morning at 8 a.m. GMT that's basically a summary of the most clicked on financial headlines of the day so far. In other words, what other traders are reading. Pretty handy. You can get it free. You can either visit that link every morning or you can put in your Twitter account or email and have it sent there. Obviously, I can't teach you everything there is to know about trading in one hour webinar. Good news is I do have some of my best workshops recorded and on an online server so you can watch them at any time you want at your convenience. And this will go much deeper into how I use each indicator, the different variations. I also cover things like money management, risk-reward, probability, and more detail. And I delve into what other trading systems leave out, the psychology aspects of it. Pretty much everything you need to know to start trading effectively, all wrapped up in a couple recorded workshops. Second link is for my live coaching. If you found today useful, imagine if we did it every single day. How about twice a day? 10 times a week, 40 times a month. We do trade setups in the morning. I turn you loose to execute them on your own. And then we compare what everybody did at the end of the day and talk about how to improve on it. Imagine what that would do for your trading. And good news, it costs less than 1 or 2 losing trades for most people. So you want to keep losing? Ask yourself the question, you want to keep losing or do you want to spend the cost of 1 or 2 losing trades for 40 lessons on how to win? Losing is expensive, not training, you guys. Invest a little bit in yourself and your future. You will see results. I guarantee it, actually. Third link, this is what we call our budget program, the weekly video updates. You don't get to interact in class. You don't get to ask questions. What you do get is a recording of our Monday morning video each week. Why? Because that's where we lay out our trade scenarios for the week ahead. At least you have some guidance and some key levels to watch. All right, but my goal is not to sell you something, you guys. These are just some of the options for you. Wanted you to be aware of it. Everything else at fxknight.com is totally free of charge. Only thing I charge for is my time if you want training. We got a free chat room, free forum, free interactive chart complete with indicators. You know, my broker doesn't have oil. My broker doesn't have the dollar index. You can plot it on my chart. Okay, you can't trade it, but at least you can see where it's going. Free plugins for MetaTrader, free streaming news, all sorts of goodies. Basically what happened is I found myself at the beginning of my trading day going to half a dozen or so different websites each morning to gather my research. So I kind of put it all in one place and combined it with helpful resources such as, you know, a chat room or a forum so you can bounce your ideas off of other traders or your strategies, etc. Get answers to questions. All of that stuff's totally free, you guys, so drop by sometime, say hello. Thank you very much for your time and attention, and I wish you a very profitable second half of the week. I'll see you guys on October 10th for Fibonacci Fridays. Take care.